financially untrained, okay, idiots that get the sheep's wool pulled over their eyes.
Yep.
There are still a ton of scammers that are out there. And I will say that 99 out of 100 times, they're not providing the right disclosures, the right information. They're not doing the things that honestly are there to protect the investors.
So Kris, I'm curious, have you ever thought about putting like a home up on Kickstarter and getting a bunch of people behind it and, pulling all these people together and buy a home together?
I'm pretty sure it doesn't work that way, but I think I know where you're getting at, which is, can real estate be crowdfunded?
You can't put a home up on Kickstarter?
I don't think so.
It quite literally can work exactly like that, but not with Kickstarter.
Ha! Oh, wait. We are joined today by Securities attorney Nate Dodson, good friend of Kris's and mine. And
let's be honest, Nate Dodson has helped me put out all of my Reg Ds, and my brand new Regulation A public fund is literally about to see the light of day. We've been working on that for the better part of a year. And Nate's helped me with just all sorts of making everything possible in the game of real estate, where the waters can sometimes be tricky to navigate. But I think today's in the spirit of creativity. Like, how does a person with limited resources do more than their bank account says that they should be able to do?
And the whole idea of crowdfunding is you can kind of diversify some of the risk and pool a lot more money together to do some cooler things. Am I right? Is that the goal, Nate?
I think you really nailed it, where how can you get into a house with a couple $1,000s down? Well, you really can't unless you're jumping into some of these syndications and investments.
So Kris, I've got to ask, how many people that follow us regularly do you think would be interested if they knew they could get into real estate with you?
Millions.
For $1,000?
No, there's millions of people that watch these videos every single week. And
the thing holding them back.
Well, and I got to tell you, I partner with people all over the world.
Right.
I partner with people in the game of real estate all the time. But most of the time, that's people putting up $50,000, $100,000, sometimes $250,000, $500,000, sometimes $1 million. And there's a lot of people out there like, Krohn, I'm starting the way you did, bro. I'm broke as a joke. I got $300,000 in my bank account. I'm part of the 60% of America living check to check. I love what you're teaching, but I don't know how to pick it up.
Get started. And what has been your answer through the years? Is people are like, I got $1,000, $4,000 to my name. How do I get started?
There's always a way to get started. I mean, Robert G. Allen was my very first mentor. He had 50 no money down strategies. There's always a way. But you know what's changed in our world today? We want it done for us. We're way less interested in learning how to do it. That's the biggest change to the last generation that I've witnessed, is that if it can be done for us, we want it done for us. And if that's the case, you need a person like Nate Dodson in your world.
Yeah, so can we start out super basic? You guys keep throwing out terms, Reg D, a Reg A, a private placement memorandum. There's all this jargon, Nate. Help us wade through it a little bit.
Sounds good. Well, to kind of start, the only time that you really care about this, if you're raising capital from investors, if you're pulling people together to try to acquire real estate, you care. Now that you care, there's a bunch of different ways to do it. There's a bunch of different regulations that you can fall under. You brought up a private placement. Oftentimes people talk about PPMs. That's a Regulation D. Regulation D is just a set of laws that dictate how capital can be raised, who can be accepted as investors, and kind of the way that it operates. But there's other ways to do it. There is a regulation, crowdfunding, which allows anybody to be accepted as an investor, which really goes a long way to really help. But you can only raise up to $5 million. With Regulation D, you can raise an unlimited amount of money, but you're limited on how you market, who you accept. And then finally, you have Regulation A, which is what we're talking about with Kris over here, that you can talk about it, you can market it, you can sell to any investor. And generally, there's smaller investment requirements, meaning you can get the $1,000, $3,000 investment opportunities, but you can only do that up to $75 million going through a process with the SEC.
Yeah, so we've done 6,500 different single family homes. I chose to scale in an area where all my competitors said, that's stupid, you can't do that, you should graduate to multifamily, to commercial. I said, bro, how do you graduate from an amazing ROI to a smaller ROI just because it's easier, just because it's simpler? I mean, think about this for just a moment, right? I've got, if I buy 100 single family homes, I have to underwrite 100 properties. I by each door individually. I need property management on each one of them. But someone else says, Kris, I just bought a multifamily complex with 100 units. It's a single purchase. And it's one property manager managing all of that. Isn't that more scalable? And my answer is yes, it is more scalable, but not if the ROI goes down. That's a problem I want to solve. And so it's almost $2 billion worth of real estate that we've transacted, over 6,500 projects. And we've learned how to hit these amazing double-digit ROIs. And it doesn't get you rich overnight, but over 2 decades, like a little bit of money that was sitting in a 401k or an IRA or a little equity in a home can turn literally into millions of dollars through the power of meaningful compound interest. I write about that in my book here, Have It All. I teach 5 different investments and classifications of ROIs: single digit ROIs, double digit ROIs, triple digit, quadruple digit, and even an infinite ROI. So the double digit that I talk about is real estate, because I don't touch a deal unless we're making a 25% ROI, but really we're averaging over the last decade 34%. And that means that a little bit of money over, the working life of a human can turn into a small little fortune.
I heard you say something recently, Kris, that I thought was interesting. And you said anybody can make something complicated.
Yeah.
A genius can take something complicated and make it stupid simple.
Yeah.
And I think that's what you've done with your single family approaches. Yeah, it's complicated on our side, but for the investor, for the people coming in and partnering,
well, and coming back to what Nate's talking about, most people that partner with me all over the world, they've got money sitting in an IRA or a 401k, and they're not happy with its performance because it's just single digit. It's only going to maybe double 3 times in their working life, and they know that that's not enough. They've run the math finally, maybe a little bit too late. And then they say, well, I need to do something smarter. I need better ROIs. And those people will come to me and just partner with me. We'll form an LLC. And Nate, in that situation, do we have a security? If I have a relationship with an investor and we form a simple entity and we start buying real estate in that entity, is that actually a security that requires, Reg Ds, Reg As, paperwork, syndication, paperwork, all that stuff?
The reality is you don't have a security unless you're combining a bunch of people together.
Got it.
In this case, you're joint venturing with one individual that needs your expertise, needs your help, needs your guidance, needs your services. So it's completely different than, say, putting together a fund where people just contribute some money and then they fade off to the distance, other than receiving their dividends or their K1s, or really they're passive. And if you have one passive person, you don't have a security because you don't have a bunch of people. You have multiple active people where you and your family want to start buying properties together. You're all active in it. That's still not a security because everybody's active. So there's just different ways to approach it.
So the moment something becomes a security, though, everything changes.
Oh, yeah.
Can you speak to that a little bit? Why is that and what changes?
So there's an unbelievable amount of laws and regulations surrounding securities. There's an entire SEC, Securities Exchange Commission, that's there for securities. Every state has regulators that oversee the securities and the investments. And there was a great stock market crash back in the 1920s, end of it. And literally that birthed all of these very stringent laws that were draconian in the amount of information that had to be provided. And if you didn't if you didn't follow the rules, well, then you're paying massive fines, you're risking jail, you can't bankrupt out of these risks, and you may ultimately be kicked out of any sort of investment business. And that includes, you're an entrepreneur, you're in real estate, you're working with investors, because you can't fund everything yourself. At some point you hit your limit, you need to be working with other capital sources, and then all of a sudden the securities start to apply, and that's why we're here.
Did I hear wrong? Did you just call the SEC draconian?
The laws are draconian.
I know.
The SEC is will beat you up for the fun of it.
I'm going to tell you personally, they are a formidable organization that you that's a devil you don't want to dance with. Yeah. But no, I mean, think about a world that we live in. I think people are fairly skeptical these days, and think for just a moment about a con artist. A con artist might go around trying to sell someone on some type of investment, going to con you out of your money. You're going to be a passive investor. And it's like, who's going to protect innocent people from being preyed upon? The SEC comes in and says, well, we actually have a bunch of rules to make sure that everything is properly structured, put together, things are fully disclosed. I mean, that's really the protection, Nate, that exists for people. It's not just con artists, it's even well-meaning people that are like, no, this is a great investment opportunity, but I don't know, maybe they're new to the game, maybe they're not as experienced, maybe they don't have much of a track record, they're just getting in the game. There's all sorts of things that have to be disclosed in the information provided so that you don't have, unsuspecting, less sophisticated, financially untrained, idiots that get the sheep's wool pulled over their eyes.
Yep.
There are still a ton of scammers that are out there. And I will say that 99 out of 100 times, they're not providing the right disclosures, the right information. They're not doing the things that honestly are there to protect the investors. Mm-hmm. And those are also the people that, have problems. But if you don't have paperwork that says what's going on with your investment, who's doing it, what your interest is, what the risks are, there's a higher likelihood and risk factor that you are working with one of these scammers.
Well, and I think in all likelihood, Kris and Nate, most of the people that are going to be listening to this have more likelihood of participating in some sort of fund than they would in starting their own fund. Yep. So would you say that's something they should watch out for as they're looking at investments, read the papers, read the fine print, get a lawyer?
Most important things in the world. Now, getting a lawyer, all paperwork should be written in, there's a requirement for it to be plain English, meaning you're supposed to be able to have, as an investor, read it, and understand it. A lawyer, we're good at finding what's not there or what is so ambiguous that it really doesn't matter what it says. It allows the guy that was raising the capital to do whatever they want. And a big part of this is saying what your money is going to pay for them to do and not allow them to use their money however that sponsor, that operator wants.
It's like Kamala Harris. I never understand anything that she's saying.
Plain English.
Do you know what I'm saying? There's no plain English that comes out of that woman's mouth.
She's an attorney. I apologize.
Is she an attorney? Is she an attorney?
She is.
That's awesome. Okay, so let's talk benefits, though. I mean, clearly there's some huge benefits.
Well, so this is exciting. It's true. Like this next year, I'm coming out with my first ever fund. I'm really excited about it because I feel like I've amassed this massive track record. We've done this for the last 2 decades. And we've proven that whether the market's going up or down, we know how to win. But the reality is, up until now, if someone wants to partner with me at a serious level, they have to often have $50,000 to invest or hundreds of thousands of dollars to invest just to kind of start at an entry level. That means that there's a lot of people that are watching like, well, dude, I got $3,000, I got $5,000, I got $10,000, and they want to be in something, but they don't have the way to get in. And so this fund gives me the opportunity to say, hey, let me get you in on the same amazing juicy real estate that I buy every single day, because frankly, there's more of it than I have partners. And so this is actually, I think, a really, really great, exciting win-win.
Well, and Kris, you've done funds for years.
Yes.
You've been doing this sort of stuff for a long time, but they've all been private funds.
And never a public fund.
And so this one's a public fund. And I mean, who can participate?
Well, I'm going to come to Nate on that one. Who can participate?
Absolutely everyone.
Yeah.
There's no limitation. The limitation comes down to how much they can invest.
Okay.
Yeah.
So there is a restriction that they can only invest up to the greater of 10% of their income or their net worth. So there are some restrictions on there, but the fact that you can accept 300 million plus investors from the United States really goes a long way. And that's exactly what allows you to accept the $1,000, $3,000, $5,000 investors. Because when you're doing a private fund with all the restrictions that are under Regulation D, that's where we see those minimum investments of 30, 50, 100,000, because it is so much work and you're so limited on your investors, it doesn't make sense to work with the smaller investors, where in this case, I actually see it as not just allowing everybody to work on their financial well-being. At the end of the day, it really protects everybody as well, because you get maximum diversification. Your risk factor is minimal if you're not putting your whole net worth into something, like often seems to happen with Regulation D or these private funds. So there's a wonderful world of now this group can participate. American can participate in the growth of the real estate, which really wasn't available for 80% of the individuals out there.
So you mentioned a benefit of diversification. Help me understand a little bit more versus someone going out and just buying a single family home. How is this more diversified?
Sure. You go out, you buy one single family home, you've got one asset.
Yeah.
If that geographic area is Las Vegas in 2008, it doesn't go well. But you don't have diversification. You can't be everywhere. With one of these Regulation A funds, or even with the private funds, all of a sudden you can have interest in properties all over America or wherever you're really targeting, but you're not relying on that one asset on that one street to make up that gain. You're just really more looking at the macroeconomic real estate industry across America.
You know, I see that personally because I always give my investors, they always have two opportunities of how they buy real estate with me. One is we form an LLC and we just buy it one-on-one.
Yeah.
You know, and we become 50-50 partners in that asset. And then often they want to buy a second, third, or fourth home. And what they own is a small portfolio that in time is designed to double and triple and quadruple and expand. And as time goes on, as the portfolio grows, they actually get more safety because it's like, oh, we now own 20 homes, and guess what? One of them was a dog. And you're just saying, whew, I'm glad the first one that I bought wasn't the dog because that could have really ruined my trajectory.
Thank you.
The other option, though, is I'll also have my partners, once I have a relationship with them, they can come into a fund where we privately have everything come together and we buy homes cash. And there's a lot of people that will choose that option because they're like, well, we're already going into a bunch of homes together. So there's way more diversification so that if there's a dog in there, it's going to get averaged out by all of the other good winning properties that we have as well. So there's greater safety from that point of view.
So don't shoot me for this, but it's almost like an IRA or a 401k, but with
Don't ever use that.
homes.
Don't you dare. Don't you dare. Cuss words, swear words.
Nate and Kris are shaking their
know.
heads at me so hard right now.
Dude, like, so honestly, you can't say those words because I'm offended at anything that pays a single digit. Because everyday Americans are duped into a model called 401k IRA, and those two vehicles represent their entire nest egg. They think they have diversification because it's invested in multiple blue chip companies, et cetera,
Right.
but it's really just all the stock market.
Right.
And the problem is that we already know that a 401k's 30-year average is 5%, that an IRA is 6%, that they're not even doing the S&P 500, even though that's 9%. And the reality is with Rule of 72, you know, a 401k is going to double every 12 years. And if you're going to work for 40 years, what is it going to do? Double 3.5 times? So for the average person, that's why at 65, they have an average of $209,000 balance. And it's like, cool. I worked my entire life and I followed society's game plan. And thank goodness for double digits. Wait, never mind. That didn't exist. My single digits in my 401k and IRA, I now have amassed $209,000. You know what I can do with that? Some really cool things. One is, I hit my peak earnings at age 55 of $95,000 a year. So if I don't want to adjust my lifestyle, that retirement will last me like 2 years. How awesome. So glad I worked 40 years of my life so that I could save up 2 years worth of living. Oops, that's not going to work. I'm not going to die that fast. You know what? I will cut my lifestyle in half and move into scarcity next door, also into poverty, and then make it last for 4 years. Nope, that's also a problem. It'll be gone. You know what? Stupid me. I should give it to my financial planner and say, hey, I can't afford to lose the principal. Give me the maximum interest that you can. And they say, well, we can annuitize that and give you 3%. Awesome. What's 3% on $205,000? And they say, well, that's a few $100 a month.
Yeah.
And all of a sudden in that moment, that's when you realize, I need a time machine. I'm going to invest $209,000 into a machine to take me way back 40 years so that I follow someone else's advice.
So I think right here would be a good time to drop we're not providing financial advice and you should consult your attorney and CPA, but
mine's right here.
But yes,
No legal advice.
definitely. But Kris, is the ROI the same then on these funds versus doing the like?
No, I mean,
LLC?
at the end of the day, and the paperwork and the disclosures and everything is there,
Yep.
but we're targeting always a double digit that is never less than 25%.
Really?
And
Even
we're
on the funds?
averaging closer to 30 to 40%, like I was saying earlier. And what that means with the rule of 72 is your money potentially illustratively doubles now every 2 or 3 years, as opposed to every 12 years. And it goes to this age-old question: would you like $1 million or a penny that doubles every day for a month?
Penny that doubles
The
every day.
pun, everyone already knows it. The penny that doubles every day for a month is going to be a lot bigger than $1 million.
you do the math.
And it's just illustrating compound interest.
Yep.
And when Einstein said that compound interest is the most powerful financial vehicle ever invented, he should have thrown in this disclaimer: as long as we're talking about double digit on up, because we all have a lifespan. And single digit does not compound meaningfully enough until you're in your 4th or 5th life, hundreds of years out. Double digit, that can shave that off dramatically. So while I can't guarantee any performance, I can't guarantee any returns, what I can tell you in principle is that when you look for investments, especially if they're passive in nature, so you can stick with your career, keep making money for your day-to-day, but if you can find a way to sustainably produce a double-digit ROI beyond 25%, that's when in a working life you can produce something extraordinary. You can't do that with single digit. It's just not enough.
So while we're on this topic of crowdfunding and securities, there's a term that gets brought up a lot that I wonder if we can discuss, and that is this idea of being an accredited investor. Nate, could you talk to me a little bit about what this means?
Definitely. Well, accredited investor, honestly, it's a definition. You're worth more than $1 million, or you make $200,000 a year, or $300,000 with your spouse. If you are in this category, there's a lot of other investments that you're allowed to do that if you're not able to, if you are not accredited, unaccredited. So as an example, it's funny, and people don't realize this. Under Regulation D, it doesn't say an unlimited number of accredited investors can invest. It actually only says 35 sophisticated investors can invest. The SEC doesn't even consider an accredited investor as an investor. That's where it gets, I know, it's strange. But the SEC is not there to protect the accredited investors in a general sense.
So they're kind of saying.
So the SEC basically says this is our definition that if someone is at least worth $1 million, or if their combined income is $300,000 a year, or personally $200,000,
we don't care about you.
We're going to put you in a class that says if you get the wool pulled over your eyes, shame on you. You had money, you lost money. We're trying to protect, grandma that has like $22,000 left to live off of before she dies, and the con artist came by and said, "I've got a $21,000 investment that will make millions of dollars."
In your mind, do con artists always have like this?
Yes, always, every single time. Yes.
And
And they do them wahaha. Like how come people don't get it, right?
I don't think scammers wahaha
Catch
anymore.
the
Scammers sound more like, "Hi, I'm a king in Nigeria," and
And I just won
that's
a lot
the scary part is a lot of the scammers sound like your best friend.
yeah.
Not are your best friends, but they're there to show up and say, on that game of golf, "Hey, I've got this great deal for you." Only if you're interested, but you can get this astronomical return unbelievably fast. What they don't tell you is your return may be coming from that next investor, and your investment went to the guy before.
Isn't that a
Ponzi scheme? It really is, but that's often what happens.
Yeah.
And that will get you put in jail.
So the reality is crowdfunding, it's real. There's, however, a way to do it right. There's definitely ways of doing it wrong. If you need someone like Nate in your world to help you do it the right way, Nate, your website, crowdfundinglawyers.net.
You got it.
Crowdfundinglawyers.net. And you could go there. And by the way, just last year alone, you guys launched how many different funds?
I said 200. It was actually closer to 250. Funds funding over $1 billion just last year.
And we won't drop names, but you're doing some of the bigger names that are definitely out there, including my own.
The biggest names right here.
Yes.
I do have to drop Cardone's name, and we've been picking up quite a few very well-known guys that are doing amazing things in the real estate market, such as the man right here, Kris Krohn. And really, we appreciate and enjoy doing it. Awesome. It's fun.
So, final question. I think we're about time to wrap up. But Nate, how much does a track record play into your opinion, your ability to set up a fund? When you look at Kris's track record, was that a big factor?
I will tell you, it is the number one factor in setting up a fund is what have you done lately? Kris, you've brought up hey, you're raising money from your friends and family. Hey, you're thinking about multifamily. The reality is if you don't have a track record, maybe you can find some investors, but they're not attracted to what you can do. They're attracted to the real estate, the demographics, the opportunity of kicking the dirt, where if you're setting up a fund, all you have is a track record. And they're investing because they believe in you and they believe in what you can do.
Okay, Kris, final words on crowdfunding. Good thing, bad thing.
My very first partner was my father-in-law. When I bought my first house, I had to do it all on my own. And I remember he thought I was a little crazy because I'm a college kid. I just told him that I now have an undeclared major. I don't know what I want to be when I grow up, but I want to buy a home in a college town. That seemed a little bit backwards. When I bought my second house, he expressed concern. He's like, are you guys getting a divorce? Like, why do you need two houses? When I bought my third house, I think he wrote me off as just kind of probably an idiot.
The guy likes houses.
Yeah. He didn't really understand because he was your traditional 401k or IRA, and he did well. He had ownership in a company that he built for 35 years, and he had an exit at the end. Like all his eggs were in that one basket, and it worked, right? But I remember when I was buying my fourth house, I got this call out of the blue from him, and he said, Kris, I'm celebrating my anniversary in the Bahamas with my wife, and I had a dream about you.
You're like, that's what you're thinking about while you're in the Bahamas?
That's kind of weird. Tell me more. And he said, well, I dreamed that we were doing real estate together. And I'm like, you mean you, the guy who I'm pretty sure thinks I'm just kind of stupid or crazy or off the wall or whatever? And he said, well, tell me about these houses and tell me about the numbers. And so I started going through each one. And I could tell, I was hearing the click of a calculator. I was definitely hearing the pen and paper scribbling numbers. He was calculating my ROI, and I knew it because he was asking about rents and value and what I'd buy it for, what was it worth. And I knew what my ROIs were. And by the time I was done telling him about my third house, he said, well, what's your next move? I said, well, it's funny you should ask. I'm buying this fourth house, except I don't have the money for it. Normally, I've just been taking the equity out of the first house to buy the next one, and I'm too early. I found my next deal too soon. And it was his idea. Kid you not. He said, what if I come up with the money and we split it 50-50? And in that moment, I felt like I won the jackpot. I was kind of angry that it wasn't my idea. He opened up this creative door for me. We ended up doing the deal. It worked. We made all this money. And then we did it again and again. Then we did it 10 times. We did it 50 times. And I remember by the time we had bought 10 houses together, I thought, this is amazing. I now have more of a track record. I've got this dialed in niche, the system that's working. And I was like, I got to let in more people. And so I need more father-in-laws. And I found like 4 people that were father-in-law-ish. They're like kind of his age. They had their careers. They had been great savers.
Probably dentists and doctors.
They were dentists and doctors. One was a dentist and one was a doctor. One was an executive. And I basically took all 4 to lunch one at a time, and I showed them my portfolio of now like 12 homes or whatever. And every one of them, it's like I could hear it in their mind. It was right across their forehead saying, this kid's kicking the trash out of my 401k. Let's partner up. All 4 said yes. And I was now buying a home a month as I rotated them. And that was many, many hundreds of partners ago. And my expertise has been building wealth with people where I do the active work, I do the heavy lifting, I leverage my track record of thousands of homes. And they get the benefit of, in many of these cases, this is a one-on-one partnership. This is a relationship. I can text Kris and connect with him, and he's got his accounting team, et cetera. And it's been good. So I'm a huge fan of partnering. I would say the crowdfunding aspect and these Reg D filings and the Reg A filings, they're giving me the acceleration to take partnering to a whole new level, to work with a lot more people. And if I had done this 10 years ago, it would have terrified me. But with my track record today, real estate bores me. There's nothing new to learn. We've seen it all. I swear we've done it all. And so it's exciting. It's exciting to say, okay, let's amp this strategy up at a whole new level. I swore after the last recession that I was going to do this one way bigger because the real estate I bought in Vegas and Arizona, thousands of homes, within 5 years, I made my investors over $100 million in gains. And I thought, man, the next time I see a recession, I'm only going to see 2 or 3 in my life. The next time it comes around, the next time the market softens, I'm going to go crazy. I'm going to go buck, and I'm going buck right now. And Nate's helping me do that. He's been helping me as my lawyer put all the proper paperwork together. But we've got the track record, and to say the least, I'm excited.